We now have our penultimate panel of the day, and we are going to be talking about alternative finance with two people leading that area of fintech in very different ways. Now, as you know, smart financing solutions offer a democratized route to securing loans and investments. But with customers' pockets being hit, how do we unlock wealth through flexible financing and innovative funding models? Joining me now is Matt Cooper, the co-CEO and Chief Commercial Officer of Crowdcube, and Vaibhav Tiwari, co-founder and CPO of Scroll Finance. Please welcome them to the stage. Please have a seat.
You see?
Yeah.
We'll sit here. Oh, yes.
Matt, Vaibhav, thank you very much for joining us today. You both come from really different kinds of companies, so I just guess for the benefit of the audience and for all of us here, could you just give us a very brief summary on the overview of your company and how it works and what customer needs do you look to fulfill?
You go first?
So I'll go first. So Scroll Finance was founded 2 years ago. Our tagline really is smart financing for homeowners. So if you're a homeowner and you're looking for a loan and no one else can give it, you'll probably come and look for Scroll Finance and we'll try to help you.
Okay, great. Matt?
Hi everyone. So Crowdcube is a pan-European marketplace that connects companies looking to raise capital with retail investors and their customers. We've been doing it for 10 plus years. We raised about 1.5 billion pounds for businesses all across the EU and the UK, and amassed a retail investor audience of 1.4, 1.5 million retail investors. So all quite exciting.
Absolutely, and actually interesting to note, I was reading that last year you saw, I think it was a 29% growth in investor registrations and also welcomed more than 100,000 new investors in private companies. It seems strange because 2022 was such a torrid year in terms of the markets and in terms of geopolitically what was going on. What was the driver for that, do you
Was
think?
that torrid or horrid?
Horrid.
Bit of both.
Yeah. Both, yeah.
Yeah, in all honesty, we surprised ourselves, I think, with some of those numbers. Companies need to continue to capitalize themselves and raise capital. We'd broadened the playing field that we were operating in. We're the only company in the world, actually, that holds dual UK and pan-European regulation to enable retail investment into private companies. So our playing field had got bigger. It wasn't just UK-centric.
Is that quite unusual, then, to have UK and European?
We're the only people in the world that hold that regulation. So yes, it is quite unusual. But it enables us to raise capital for companies all across both the UK and the EU now. Last year was torrid and horrid. There were lots of shocks to the system, and it seemed that there were shocks to the system, you know, on a weekly and certainly monthly basis. Yeah. But companies continue to raise capital. Investors continue to want to invest in alternative assets. They definitely weren't investing in crypto last year, but they continue to invest in private companies, and we saw that in our data. And some of the interesting things that we did see was the continued democratization of that investment into private companies. We'd had a record year for female investors into companies, for instance.
Do you know what was driving that? Why was that?
What often drives it is the companies looking to raise capital. So if they're very, very female-centric brands, they'll often appeal to a big, wide audience of female investors. But I also think there is a point about creating more pathways and more accessible pathways for underrepresented bodies of retail investors in the UK and Europe to invest in alternative assets like private companies, and I think we did that pretty well last year.
That's interesting. I mean, you are also appealing to alternative markets. Who is it that you're specifically trying to appeal to?
So at the moment, we are appealing to buy-to-let landlords. So folks who have 2 or 3 properties are looking to raise capital or fundraise for the next property. We'll be serving them. We plan to go to owner-occupied, as we'd call people like you and me, looking to raise funding from their home equity. It will be the person to go for.
And how do you, if you had to define alternative financing, how would you define that? It seems like such a broad term.
Yeah, I think there's a number of different ways you can define it. If I think about how we think about our place in the universe and the finance landscape or alternative finance landscape, we're just very focused on creating ways for retail investors to invest where previously they couldn't, wouldn't, or shouldn't. Now that normally was because they came from a certain economic background, or their parents didn't work at a certain investment bank, or they didn't go to a certain school or university. And by creating those new pathways for people to invest, we see ourselves as an alternative. But actually, when you look at the numbers now, one thing we wrestle with internally as a business is by transaction number, we're the biggest EIS investor in the UK. That's by definition not alternative.
No.
So why should we still be labeled alternative? So it's something, as somebody running the business, I wrestle with quite frequently, is like, how disruptive and alternative are we when we're actually quite mainstream when you look at a lot of the data?
I mean, do you not want to be alternative, or do you just feel
I
like
like
it's
being alternative. I don't want to wear a suit, and I want to wear trainers and maybe not shave today.
You could still do that if you were mainstream, Matt.
That's true, yeah. I think the label you give yourself can help attract a certain type of talent potentially to the team. You know, people want to work at disruptors and alternative finance firms, but sometimes that label is not particularly helpful, because I think you kind of you create in your mind like you're a smaller business than you actually are.
Yeah.
So we'd like to believe that we are clearly specialist lender. So if you go to a Main Street lender and they can't help you, you are looking for that specific solution. And in the industry parlance, in mortgages, probably you will classify us, if you have to, as a specialist lender. But we clearly are an alternative to the big high street banks and where I was a part of previously. So I think the definition of the term is critical to understand, you know, what really it means. But I just feel that, yeah, we are an alternative to slow processes, things which take time, but clearly we would want to give a solution which is alternative to what you have seen.
And have you seen a big growth as well in people coming to you, particularly last year and this year? It's a very uncertain economic time.
It is.
And rates have really gone up. So is it buy-to-let lenders are having, people who want to borrow are having a difficult time securing loans?
Yeah, so I think the term was used, horrid and torrid 2022. So as I said, we started exactly 2 years ago. Last year, around February, we wrote our first loan. So the year was game of two halves. The first half was elation. We wrote the first loan, and obviously we were just going at breakneck speed. And then came the mini budget. Obviously our funding was coming from a US fund. They basically got spooked and said, hey, we are not playing with you because we have these covenants. So the second half was really, really tough to get through. So overall, I just feel that the market continues to be challenging. Obviously the interest rates have gone up massively. We believe they will come down, and I think affordability will start improving again. So we are hopeful, but it has been a tough gig. Yes, in the last 6 months, 8 months, it's been tough.
And do you expect it to stay tough, or what are the prospects as rates potentially have reached their limit of going up, or we're very close to that point? How will that impact your business?
So I think the most important, given in mortgages, I think the most important actor probably is the government. So I think they have a lot of tools up their sleeves still. So to answer your question, I think I genuinely expect that things will thaw from this point onwards. And we're already seeing gilts wherever the interest rates are, they are following. So I think we probably have seen the peak of interest rates. Do not forget what the folks were saying last year. It was all doom and gloom sometime in October. So we have turned the corner. I think I remain optimistic for the rest of the year and probably more positive about Q1 next year.
Let's talk a bit about that mini budget drag. How did that impact your business, Matt?
Well, I think it was another unwanted kick in the teeth, whatever you want to call it, in what was a challenging year if you're a founder running a company. There was a couple of interesting things that I think came out of it towards the end of the year. You know, for us, 2.5 million new people got dragged into a higher rate tax band and became, in the UK, a little bit more inquisitive around EIS and SEIS. That was at the same time as the amount a company can raise. SEIS is the tax break that a higher net worth or higher rate taxpayer can enjoy if they invest in high-risk early-stage businesses.
So that's slightly different to EIS then?
It's the same principle, it's just a more generous tax break.
Okay.
But that got increased. You know, the Treasury were very clear. One of the good things they did, very clear that they're not going to sunset EIS, which has been absolutely critical to some of the greatest technology companies that have been built in this country in the last decade. But this new cohort of individuals have become more EIS savvy, which is great for us. We do a lot of EIS investing and a lot of EIS investment opportunities. We've interestingly actually just partnered with Octopus Investments to lower or reduce the barrier to entry for VCT investing, which is an EIS efficient investment opportunity for retail, from circa £5,000 down to £500. Again, sticking to our mission about creating more pathways for retail investors to invest in private companies. So I think there was, to answer your question, some good things that came out of it. There was a lot of not so good things as well.
Do you think it has made a lot more people start to think about the importance of tax-efficient investing, you know, particularly being dragged into those higher rate tax bands?
I think so. I think it's, you know, when we look at our data, we processed some 200 and something thousand individual investments last year. Lots of those were UK retail investors, and lots of them don't claim tax relief, despite qualifying, which is kind of crazy when you think about it, because it's free money. So I think there's a great deal of education that can still be done. I think there's a great deal of education around the VCT industry in the UK, which we are in the process of doing with Octopus, our partner on that front. But I think this concept of retail investors wanting to invest or continue to invest in alternative assets is not going away. We're one alternative asset with private company investing, but it might be wine, it might be, you know, mortgage-backed securities, it might be classic cars, it might one day be crypto again, we don't know. I don't think that's going away. I don't think we're going to revert to how my mum and dad used to invest in things.
Vaibhav?
As a lending business, we do not provide any kind of tax efficiency. We are not ESI certified, and we will not be, because we are a lending organization. So none of those issues or opportunities in our business.
How important is sustainability for both of you? I know Crowdcube, you're now a B Corp as of last year, correct? Was that something that you wanted to achieve from the beginning? And I know we talked earlier about sustainability. I'd like to get your thoughts on that too. But how important was that for you as a business? Is it also something that you think your investors would be particularly interested in? What was the driver, and what impact has that had?
Yeah, firstly, it's a long, hard process to go through to achieve your accreditation, and my team did a great job in getting that. It was definitely intentional. We realized that we were raising for a lot of capital for a lot of B Corps. We love working with B Corps. They tend to be nice human beings to work with, and they tend to be businesses that have a positive impact on the world. And we know from investor data that investors want to invest in companies that are making a positive difference to society, to the planet, and are good corporate citizens. So we felt kind of knitting that together with actually eating our own dog food and becoming B Corp ourselves was really important. So I'm glad we went through that process.
And we were talking about the importance of sustainability and people who come and get loans. What are some of those loans specifically for? Yeah,
I think what we are hearing clearly, so there are obviously multiple players in our ecosystem. There are funders who obviously would want to see a mortgage book written which is certified green. And that's what like large banks like Citi, others are telling us. Then there are obviously homeowners who want to get their homes green. And obviously here's an opportunity because our home equity is probably at a record level high at the moment. So although if you look at last year to last year, the home prices have been increasing. A lot of equity is there available. So obviously you got to watch this space, but Scroll Finance is going to be doing something interesting in the green space, which means that we will help homeowners and landlords make their property greener. And obviously the benefits are pretty clear from Rightmove data, where you can sell your property much more quickly, it fetches a premium, all of those things. So clearly sustainability is a big theme for us at Scroll, and I think we are working to come up with a more innovative proposition, which I'm probably more than happy to talk, and I can probably talk for a long time, so I'll just stop there.
Okay. Can we talk a bit about accessibility to alternative finance platforms? Obviously, you've had a lot of growth. Your company has been running for about 2 years. So how accessible are they, and do they need to be more accessible just in general? What's your experience?
So,
go on, you go.
So I think, see, at the moment, when you look at mortgages and the area where we are operating at the moment is 100% brokered. 100% brokered, which means that, and if you contrast with other economy like the US, probably the split is 90-10 or 80-20. Here it's probably 20-80. And accessibility, obviously, so clearly we got to think hard about, are there other distribution channels that we can create, D2C or somewhere hybrid? So in some sense, the moment you do that, you effectively have legislation around that. I think you will probably increase accessibility. At the moment, obviously, specialist finance guys, specialist brokers, they will have access to specialist folks. But I think it's not very, very widespread. I think there's a lot of scope to go out there.
Matt?
Yeah, I think investing in things like private companies, late-stage private companies, early-stage private companies, VCTs, private equity funds, IPOs at the point the company goes public have always historically been the preserve of the wealthy and the privileged and the connected. And that fundamentally shouldn't be the case. And we don't believe that should be the case. And we think we've made a reasonable dent in a couple of those things, but there's still a lot of work that we can do and others that work that others can do in creating kind of more, we talk about creating pathways for people to invest.
I guess it's creating that information so people realize there is that accessibility in the first place.
It's creating information, it's creating companies, which has got progressively harder over the last 12 months for founders looking to start businesses. There's all of the technology you could possibly hope for in order to get a business off the ground, but what's harder to come by is investment. And that's why we exist. But it's still been a difficult 12 months for early stage and or inexperienced founders to raise capital. As you found last year, right? You raised a pretty big round of funding last year at what was possibly the worst time in the last decade to raise capital for an early stage company.
And what do you see? You work with companies in the UK and in Europe. Where do you see the prospects more optimistic over the next year?
Yeah, I like the fact that we don't have the concentration risk of just being active in one country. That was part of the rationale or the industrial logic for getting the dual regulation, which we have. We're seeing economies in Southern Europe. We're very active in Spain, for instance. We're very active in France and Paris now. And they're coming out of the fog at different speeds. There's this also interesting Brexit dynamic where the EU are trying to be hyper-competitive in terms of their support of tech startups and financing of tech startups, particularly in France. Super, big investment going into the ecosystem there. And then the UK either lagging behind or trying to catch up. And then it's like this arms race. And it's great for us. Like the more company creation there is, the more capital raising opportunities there are, the more investment opportunities there are for retail investors. So I think in the EU, we're seeing inflation's running at different levels. Companies are raising capital at different levels. But if you look at the data for last year, it was pretty bleak for businesses, private companies, particularly loss-making ones.
In the EU and
in the
UK.
EU, you're talking 70% year-on-year reductions, and Q1's followed track really. You're down at levels not seen since 2016 in terms of certainly late-stage private company financing.
It's quite interesting because backstage, before we came on stage, we were talking about, I asked him, what's your ticket size, minimum ticket size? And I was shocked to hear it's, what, 10 quid?
£10, yeah.
£10. People can...
because it's accessible, right?
Yeah.
We like to think so, yeah. I mean, £10 would probably buy you 3/4 of a pint and a packet of crisps over the road.
Not for much longer.
Not for much longer, no.
And just, we have a few minutes left. I would love to just leave with a leaving thought from both of you, which is, how are you feeling about the future? It's been a pretty tough few years. What are your thoughts for the next 12 to 18 months?
Cautiously optimistic, I think. As an entrepreneur, I think you got to have optimism around. But I just feel, as I said earlier, all the actions which the government took, other different players took, where the market really is, what we have done as a country, I think as a policy since the mini budget, I remain cautiously optimistic, but don't quote me on that.
100% quoting you on that. I think we're past the point of peak pain.
I like that. Lots of alliteration there.
Yes, so I think it's only only going up from here. I think it's going to be a little bit of a slow road in the UK, but innovation isn't going to stop. It's not going to cease to exist. People are not going to cease to grow companies, and people are going to continue to want to invest in them. But we've had a bit of a reset, but I think we're over the worst of it.
Over the worst of it. And on that positive note, we shall leave it. Thank you very much, Matt and Vaibhav. Thank you.
Thanks a lot.